Well, good morning, everyone. It's 10 a.m., so I will call the April 14th meeting of the Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of March 10th, 2022. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have 4 items. We can take those with one motion. I have a motion and a second. Please record your vote. Item is approved. Item number 4 is to ratify approvals. We have 2 items. I have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. I have a motion and a second. Record your vote. Item is approved. Item number 6 is to approve the following applications for service retirement. I have a motion and a second. Record your vote. Item is approved. Item number 7 is receive report of death. Authorized payment of $5,000 death benefit. I have a motion and a second. Please record your vote. Motion is approved. Item number 8 is to receive report of death, authorized payment of $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 9 is receive report of death, authorize Secretary to make necessary changes to conform on the following. I have a motion and a second. Record your vote. Item is approved. Item number 10 is approve the following applications of vested rights. I have a motion and a second. Record your vote. Item is approved. Item number 11 is to ratify approval of the following to terminate vested rights and receive a lump sum distribution of his or her employee contribution. I have a motion and a second. Record your vote. Item is approved. Item number 12 is items for individual consideration. Item number 12A is a memorandum of understanding among the Oklahoma City Zoological Trust, the Oklahoma City Employee Retirement System, and the Oklahoma City MFA. I've asked Regina just to take a couple minutes and give us the highlights on this MOU, just so we all understand what's taking place here.
Good morning, Chairman and trustees. In 2019, the Zoo Trust solicited proposals to streamline their HR and payroll functions, and they subsequently entered into a contract with NeoGov. The city and its trusts, which are Zoo and Golf, who participate in this retirement system, use PeopleSoft for their HR functions and demographic data, and that all feeds through to the pension calculations, reporting for the actuaries, and that kind of stuff. So in 2020, after I came into this role, this had already taken place. The contract had been entered into. And so Zoo, Finance, IT, the city's PeopleSoft consultant, Sierra Cedar, and myself and my one person at that time began a series of meetings to discuss how to interface between PeopleSoft and NeoGov. And so the transition was implemented in September of 2021. Since the city no longer has access to NeoGov, it only comes from NeoGov into PeopleSoft. We wanted to memorialize, all parties wanted to memorialize who's doing, what functions are ceasing, what functions are continuing. So some of those, the highlights are pay plan updates with our HR reporting, producing payroll, producing quarterly state and federal tax requirements, reports, time clock maintenance, those kind of things. So the city is committing to continue to be a resource through IT, through a chargeback. But if there's any additional maintenance needed, we also have Sierra Cedar on contract through the MFA, and the city's IT department will use them as a resource. So that's why the MFA is also included in a party to this MOU. And upon approval today, it's already been approved by the Zoo Trust at their last month meeting. And once it's approved today, it will go on to the MFA and City Council in a future subsequent meeting.
Okay.
But I'll be happy to answer any questions that you may have regarding, I'm not sure if I can answer any technical questions, but anything beyond that, I can certainly happy any.
Regina, just one question. It's not a technical question, but with this change, are you getting all the data that you need to continue to do the ERS work?
Yes. We've had some issues with terminations being reported, but we think we figured that out. We are getting payroll registers produced from the zoo that are just coming over in a feed to verify what we're seeing in PeopleSoft. So the main thing is we've had a couple people terminate that will call our office and ask, where's my, I want a refund of my contributions, and we don't show them as terminated. So that has been a little bit of a hiccup, but Zoo has been very cooperative and willing to work with us, so.
Anyone else? Chair will entertain a motion to approve item 12A. I have a motion and a second. Please record your vote. Item is approved. Item 12B is contract with Allen Gibbs and Hulick LC Audit Services for FY 2022, fee not to exceed $24,994, July 1, 2022 through June 30th, 2023. Any questions? Hearing none, Chair will entertain a motion. Motion and a second. Please record your vote. Item is approved. Item number 12C is private equity program review and approval of recommendations of $15 million commitment to Warburg Pincus Global Growth Fund 14. Morning,
Okay.
Jason.
Good morning. Seems like we're doing this regularly. We've had quite a few recommendations over the last several months. Primarily, it's a function of we increased the target allocation in your portfolio from 5 to 10%. And so on a dollar basis, we're just having to put a little bit more money to work. The other component to that is a lot of the funds that we're building the foundation of your private equity program on, as they raise money in 2017, 18, 19, that money's been put to work and they have to come back to market to raise new capital. If you look at page 5 here, it's just a summary of your private equity program. This is through February. It changed a little bit in March, and actually the Warburg Pincus funds that you're invested in, Fund 11 and Fund 12, distributed over $1 million back to you in the month of March as the realizations in those companies were made and distributed capital back to you. But just as a reminder, Warburg Pincus is one of the oldest and most successful growth equity firms in the world. They've been around since the 1960s. They raise very large funds. This fund is going to be north of $10 billion, and they put it to work in what is considered growth equity. So not early stage venture capital like FirstMark that we talked about last month. A little bit more mature companies, but rapidly growing companies in the private markets. They could start companies from scratch as well, but generally these are companies that are maturing on their growth phase, but not yet public. You'll see that the first commitment in your portfolio was to Warburg Pincus 11. That was done in 2012. We made a $7.5 million commitment. That has been fully drawn, meaning fully invested to date, and that fund has distributed back $9.2 million to the system, and still has about a little over $4 million in value in the companies that are still in that portfolio. So about a 1.8 times multiple and about a 13% return. Warburg Pincus Fund 12 you made a commitment to that at the end of 2015, $10 million commitment. They've drawn most of that to date, $9.8 million, distributed back $5.4 million. That's sitting at over a 2x multiple. Very good. That's our objective here is about a 1.7, 1.8 multiple for growth equity, which should get us north of returns in public markets on an annualized basis. And so that fund up on an annualized IRR close to 22%. The most recent fund, Warburg Pincus Global Growth Fund in 2019, still early on in the life cycle for that fund, very early. We're a little over 2 years into that, but you made a $15 million commitment and they've drawn most of that capital. So just when you think about how private equity works, these funds come to market, they raise a certain amount of capital that they're going to invest in companies over the next few years. They have to come back to market to raise new capital to be able to continue to put money to work in companies. So that's why it may seem a little bit more rapid, but we're basically at the end of the investment stage for this prior fund. That fund still getting off to a nice start. While distributions, haven't been many distributions in that, which is to be expected for a fund that young. A lot of embedded value. It's at about a 1.3 multiple currently. So not to go into a whole lot of detail, I think this next page is just a good reminder of how we're trying to build this portfolio. Over time, we want to have some really anchors. Early on, back in 2008, when you first made an allocation to private equity, we were using a fund of funds. So a single fund that then invested in multiple underlying funds, and that was Mesirow, complemented by Singular Guff Distressed Fund, which that's been fully liquidated at this point. Right. As you've grown and you had the ability to really what we call disintermediate a fund of funds, so be able to build a portfolio with direct funds, not having to have that second layer of fees that the fund of funds adds. We've tried to build the portfolio through a diversified program of direct private equity funds, really with the anchors being Warburg Pincus on the growth equity side, complemented by some other strategies like Apollo and Carval on the more value-oriented side, more mature companies in private markets, and then adding more niche strategies like FirstMark, early stage venture, and Francisco Partners, which is later stage. It is still growth equity, but a little bit later stage and focused in the technology area. And we'll complement that with other things, but this is a good picture of kind of how we're capturing the whole private market. That area that you see that's open under credit origination, that would be really what we would consider more of a fixed income alternative as opposed to private equity. It really doesn't fit. The return objective for those types of strategies are more in the 9 to 11% range as opposed to really what we're shooting for with private equity in the 12 to 15% type return. Some investors might include credit or origination strategies in their fixed income allocation. We don't have that here. Just again, and we looked at this last month from a pacing standpoint, based on the size of the overall portfolio. This is the next page, Regina. At about a little over $900 million at the end of March. Actually up $7 million in the month of March at $910 million, still roughly. Your allocation to private equity today on an invested basis is that 7.6%. We're trying to build this to a 10% target allocation and maintain that. This exercise is just modeling that we do to kind of budget if we're right now, how much do we need to commit on an annual basis to get to that 10% target and maintain it. And it's roughly about $35 million a year is what we're targeting. This is not, we talked about this a couple months ago. We're not locking in 2023, 2024, 2025, 2026. It's just as today, as where it stands, this is about what we need to commit to get to that point without going too far over and to try to get to that 10% in a reasonable amount of time. Every time we make a commitment, we revisit this based on where we are. And factors that influence this, if public markets go down, public equities go down and your private market investments aren't valued at the same frequency, not daily or monthly, it's quarterly, you could see your if public markets come down, that private equity allocation becomes a larger percentage of your portfolio where the dollar amount doesn't really move. And so we want to be cognizant of that. Or periods of time, if public markets go up a lot and your private markets don't go up as much, you may lag. So we're just trying to have a fairly conservative approach. We're assuming the portfolio overall assets are growing at about a 3.5% rate per year. And you say, well, we need 7%, but you're also spending money. So it's looking at that kind of net growth. So we're comfortable right now at this $35 million mark. This would actually put us there for the year. We've already made $20 million in commitments, $10 million to the FirstMark funds, the venture funds, which we did last month, and $10 million to Francisco Partners, their smaller fund, the Agility 3, and then their main fund, Agility 7. It was $5 million each. So today we're recommending a $15 million commitment to Warburg Pincus Global Growth Fund 14, and this would really get us to our where our pacing budget is for the year. And I did tell Regina probably not going to have any others for the next few months. I don't anticipate any more private equity because we're kind of at that cap. But on the real estate side, our opportunistic real estate, those types of funds, you have a 5% target allocation to opportunistic real estate. Those funds are structured much like private equity funds. We make these recommendations in the same way. Last month we did Angelo Gordon, you did Starwood. We will have another opportunistic real estate fund recommendation in probably next month with Blackstone. So, just continuing, we still maintain a lot of confidence in Warburg Pincus and think it's a great complement to serve as a real anchor in your private equity portfolio. And so we're making a recommendation to make a $15 million commitment to this Warburg Pincus Fund 14.
Does anyone have any questions?
I just had one question, Jason. Looks like you've made some really good recommendations on that private equity. It's really supporting our portfolio. If you look at the one-year returns, it's one of the few that's hanging in there and actually giving us something. But looking forward, just for information purposes, in this private equity fund, doing good now, but looking forward, what would we look for the kind of things in the economy that would maybe make it better, better performance versus something that would weaken its performance?
Well, first of all, from an asset allocation standpoint, when we look at your asset allocation and why we're recommending going from 5 to 10% in private equity, intermediate to long term. So private equity is a long-term investment. It's not a tactical investment trying to anticipate what's going to do well over the next 6 months to a year. It's really looking out over a longer term time horizon. Our public market expectations for public market equity are low, if you recall, relative to what we've experienced the last 10 years. So for U.S. equity, our expectations coming into this year for the next 10 years are about 6.5%, where you got 17% over the last 10 years. Small cap equity is a little higher than that. Private equity is an area where we think you can add a little bit of value. It's less efficient, more ability for managers to add a little bit of value. So we think the expectations there are in the 10 to 11% over the intermediate to longer time frame. So a premium to public markets. So as a long-term investor that still needs a 7% return, we're trying to do some things on the margin that will impact that from a strategic allocation standpoint. Now, to your question, I think, is a little bit more tactical, shorter time horizon, like what types of areas. And we really look at managers to be able to tactically allocate. And if you think the way private equity works, where you're making a commitment to specialist managers, no doubt these managers have specialties in certain areas. Warburg Pincus is pretty broad in the types of sectors and industries that they can invest in. But over time, through economic cycles that we know are going to go up and down, they are able to allocate to certain industries or sectors that they think may be more attractive, either from a growth standpoint or from a valuation standpoint in the near term. What those are today may be very different than what they are 3 years from now when some of this money is being put to work. But we're confident that the manager's ability to do that is beneficial. A CarVal Credit Value Fund and the Sigler Guff Fund, which has rolled off, those are distressed strategies. So I'd say generally when we make recommendations for those types of commitments to those types of funds, it's because we think the opportunity in distressed, meaning good companies that are going through difficult times because they've got too much leverage on the balance sheet or because the markets are really selling off, we may make more what I'd call tactical recommendations of commitments to funds like that in those periods of time. So that CarVal fund is a good example. We brought you that fund in April. Let's see when that commitment was made. It was, July of 2020 is when the first dollars were called, but it was really like April or May of 2020. COVID, we thought the world was coming to an end. Prices were down. This is a distress strategy, putting money to work in that type of environment. The Sigler Guff Distressed Opportunities Fund, which you've now rolled out of, that was a commitment made in 2009 following the financial crisis. So a little bit more tactical with a fund that was going to put money to work in really beaten down companies, where values were beaten down but had good businesses. So we are able to do that on the margins with how we make commitments to funds.
If we were to consider things like maybe a recession coming on or interest rate rises that, potentially in the future, Would these private equities, would you say they would be more sensitive or less sensitive to, say, the other stocks in our portfolio?
Well, it's going to be less sensitive because the time horizon for these companies is much longer, or for these investments is much longer. And from a valuation standpoint, it's not, we're not looking at the performance of these new commitments, the impact of this commitment that you're making today on the performance of the portfolio over the next 3 years is going to be negligible to none. We're looking at this commitment having an impact on the performance of the portfolio 7, 8 years from now. So from a sensitivity to the direction of the movement of the markets in the short term, private equity has very little sensitivity. Up or down. I mean,
Okay, thank you. Very good answers. Appreciate that.
Any other questions? Hearing none, Chair will entertain a motion on item 12C. A motion and a second. Please record your vote. Item is approved. Item number 12D has us entering into executive session. What I would like to do is entertain a motion to move item 12D to the heel of the docket and move on to item 13 and let Jason give us his report, and then we'll go back to item 12D. So,
And the vote's just authorizing.
yeah.
so you all should have the March
Okay.
flash. Oh, go ahead.
I've got a motion and a second. Please record your vote. Item is approved. Okay, now we'll go to item 13, which is the investment consultant report.
So it's odd saying that March was a good month, knowing how poor the quarter was, but you did that. We did see markets bounce back a little bit the month of March, and the total portfolio was up 1%. That said, this was the worst quarter we've seen in many, many years for equity markets, and not just really equity markets. As you look at broad capital markets, whether it be equity or fixed income, everything is down. U.S., non-U.S., fixed income, we've seen rates rise rapidly. The 10 years up at about 2.88% now. So bonds are down about 5%. Really, everything is down with the exception of real estate has done well. And then from a sector standpoint, energy has done well because of just as you look at what's happening geopolitically in the world. Oil prices have spiked, natural gas prices have spiked. So as we look at active managers, it's been a pretty challenging is probably an understatement. It's been a very challenging period, the first quarter for active managers, many of which were starting to position for a little bit more of a reopening trade as news on COVID had been improving. Lockdowns, for the most part, with the exception of in China, or at least in the U.S., have been coming off, and thinking about people going back and doing the things and spending money the way that they used to. So you had a lot of active managers tilting into that to some degree. And then we, in February, shouldn't be any surprise, the Fed coming out with more hawkish statements and seeing a first rate increase of the Fed funds rate, and signaling further increases because of the inflation that we have. Couple that with Russia's invasion of Ukraine, and capital markets are down quite a bit across the board. As we look at your portfolio for the first quarter, down 4.5%. The policy benchmark is down 4.59%. So basically in line with the policy benchmark. The positives, as Marty, you pointed out, private equity, that's really more a function of accounting, and you're not seeing marks flowing through in private equity as quickly as they do in your public equity portfolio. So your private equity is essentially flat for the quarter, and that's, you know, to be expected. And that one-year number looks really strong because you're not seeing any write-downs in private market portfolios in the first quarter. We might see some of that flow through. I don't think it'll be it won't be to the degree that we've seen public markets sell off in the first quarter, but you might see some of that flow through in April or May as valuations are adjusted for some of those private market companies. Your large cap composite overall now the quarter down a little bit more than the benchmark, and on a one-year basis down about 5% more. You know, I know we say that your large cap is primarily it is implemented in what I'd call an enhanced passive strategy. About half of it is in the SSGA passive index, purely passive, and a little bit more than half actually because of great performance in 2020 in the Intech strategy. Intech is a quantitative manager. It is a benchmark risk-controlled strategy. They're not doing fundamental bottom-up research. They're owning all of the stocks in the index that they're fishing from, in this case, the Russell 1000 or large cap core universe, but they're weighting them differently than the index would weight them. The index is weighting based on capitalization, so the most expensive stock represents the largest position. This Intech strategy, since its inception, its approach is to what they call a volatility capture, so they're allocating a little bit more to the stocks in that index that are smaller cap. It's not small cap stocks, but they're the smaller companies in the index. So in periods of the time where the mega cap stocks are really outperforming, this tends to lag, and that's caused quite a bit of dispersion over the last several months as small cap has underperformed large cap. If we went back to 2020, that was a huge boon as smaller names did better. Over time, it's tended to add value. Your small cap allocation down about 6% on the quarter, a little bit more than the Russell 2500. On a one-year basis, we're slightly positive and ahead of the benchmark. Long short equity, we've talked about this, a couple of things happening here. We would certainly like to see a little bit more protection, and it did protect in February. Wasn't up as much in March when the market bounced back. A big theme here is what we're seeing throughout the whole portfolio. A little bit higher allocation to growth and a little bit higher allocation to smaller companies across the overall long short portfolio has had somewhat of an impact in the near term. International markets, again, everything has been down. The more we're leaning toward growth and not energy and materials, which most managers aren't, that has had an impact. The EM, that's the Allspring strategy, the one-year return down about 14%, whereas the benchmark's down 11%. That really wasn't Russia. Russia's had a limited impact, and we talked about that last month because it's such a small part of the benchmark. This was more China exposure, and in the third quarter of last year, that July to September period when China started pushing out policy that impacted certain industries or sectors, and there was some exposure to that, the for-profit education sector in the Allspring portfolio. Fixed income, typically we would see fixed income providing some protection in down markets, but because we've had rates rising, we've had a culmination of events that is kind of a double whammy. As rates have risen, fixed income is down as well. So your overall fixed income down 3% on a one-year basis. The benchmark, the aggregate is down 4%, so down a little bit less. Some of that has been that's due to the diversification within the fixed income, and actually the non-U.S. Bond portfolio, the Brandywine strategy, was beneficial. It's down on the quarter, down 2.38%, whereas the aggregate's down about 6%. So that doesn't, it's still down 2% in bonds. That said, what's important to keep in mind, as a long-term investor, as rates rise on your fixed income allocation, it does impact you in the short term because valuations come down. But longer term, as a long-term investor, higher yields are better for fixed income, for pension funds. As yields go up, you're getting a higher expected return. One of the, as we talk about asset allocation, our expectations for the next 5 to 10 years relative to the last 10 to 15 years is that fixed income yields are much lower starting point than they were 10 years ago. Now today, we're about back to that same level, closer to 3%, which is still low relative to long-term historical. If we go back over 50 or 60 years, the average yield on the 10-year is north of 6%. And we're still, we're thinking we're at, we're close to 10-year highs at barely 3%, so barely half of that. That said, it's just important to keep in mind as yields go up, short-term pain, but going forward, you're a little bit better off because you got more cushion there. Finally, the real estate continues to be strong. Real estate returns domestically have been very good. Thinking about the real economy versus markets tend to be a leading indicator. The real economy in the U.S. it's still pretty overheated. Valuations in real estate still going up, unemployment very low. You're seeing some wage inflation, but the real assets in your portfolio, that 15% target allocation is really designed to do what it's doing right now. It's a premium return to fixed income, less risk than equities, but also provide an inflation hedge. As there's inflation in the markets, real estate should act as an inflation hedge because of the ability to increase rents in the properties. And you're really seeing that flowing through the one-year return of 27.5%, so very strong returns there. We'll continue to monitor things closely. We don't think there's any recommended changes to your overall asset allocation or our individual managers. You got to keep in mind the long-term view, and as we look back, I'm not using 2020 or 2019 as an excuse, but the relative returns to the benchmark when you're way above, when you're going to have some chance. It's not always going to be above that. Longer term is how we should look at things. As we look at your portfolio over 5 and 10 years, the 10-year return of the total fund through the end of March up over 9%, which is about, on a gross basis, an 8.5 net of fees, still well ahead of that policy index, and more importantly, well ahead of your assumed rate of return of 7%. So we know we're going to have periods, and we've just not had one of these for 3 years now, and now we're experiencing that. So no recommended changes to managers or allocation at this time.
Anyone have any questions? Hearing none, Chair will entertain a motion to accept Jason's report. I have a motion and a second. Please record your vote. Item is approved. Thanks, Jason. Okay, we will, well, let's go on to item number 14. Any comments from board, staff, and citizens? Going once? Chair will entertain a motion to entertain. No, we don't do that? Well, thanks. Okay. Then we will move back to item 12D, enter into executive session on the advice of municipal counselor to receive confidential communications from its attorney concerning the case of 2U Incorporated Securities. Do we have to take a roll call vote? No?
We already did.
We already did. Okay, we approved it. Okay, we will go into executive session and return. Okay, we are back. The trustees have been advised, and we will move to item number 14, comments from, we already did that. Then we'll move to item 15, adjournment at 10:50. Thank you, everyone.